Hello, everyone, and welcome back to Trading Simplified. This is our seventh show. Wow, time is flying by. So, what do we talk about? Well, I decided to come back this week to what you need to hear, and I really need to get into that. And we really need to get a lot of this groundwork done so we can move into a lot more things. And I know everybody's mostly interested in setups and things like that, but we're going to get to that. And I'm going to show you how this is all intertwined with everything. Now, money and position management, very important, as you'll see just in a few minutes. And I want to focus on the secret sauce. And that's really what makes all this work really well. And that's where the money is. And then as time allows, you guys already figured out the mystery charts. So we'll go through those pretty quick. Not a whole lot has happened there, but I have a new one for this week. We'll get to those towards the end of the show. Now, just real quick, and I will pull up the slide again at the end. If you need to reach me, davelandry.com/contact. And if you want the slides from this presentation, plus for now, I have the slides for all other 6 episodes. Just go to that link. If you're watching the show live, give it about an hour or two for me to get those slides up and running. So again, there's what you want to hear, and believe me, I know what you want to hear. You want to hear about setups and the latest and greatest markets and things like that. But what you really need to hear is obviously a lot of trading psychology and quite a bit of money management. As I've said before, after I speak, when people come up to the stage afterwards, a lot of questions on the methodology, and that's exciting, and I'm excited to talk about it. Otherwise, I wouldn't be here. But the main thing is when somebody comes up to me and asks me a money management question, which is usually 1 out of 10, if that many, I know that that trader has either made it or is close to making it. Now, you have to really see trading as being holistic, and this is a reoccurring theme with me. You can't separate the methodology from the trading psychology or mine and the money management. And I'm going to show a little bit today how those three are intertwined. That's kind of a reoccurring theme here. One thing when it comes to money management is that money management will cure a multitude of sins. It's going to help you with a lot of your psychological issues, and all you have to do, and I know easier said than done, but once you come up with that money management plan, you just have to follow it and let the chips fall where they may. I don't know, easier said than done. So you guys have probably seen this chart before, so let me just breeze through it really quickly. Regardless how much you lose, or I should say regardless how much you make, if you make 1,000% of your account or 10,000%, if you lose 100% of your account, you're obviously blown up. Now, this is why it's so crucial to keep drawdowns at a minimum. So if you're down here and you lose 10%, well, you have to make back 11.11%. which is doable. But when you get further down this graphic, and let's say you lose 50% of your account, then you have to make back 100% just to get back to break even. And then obviously that grows geometrically from there. If you lose 90% of your account, you have to make back a 900% gain just to get back to break even. Now, I truly believe in keeping things simple. I spoke in San Francisco a couple of months ago, and I had cocktail napkins made because I always say if you can't show a trading system on a cocktail napkin, throw it out. And then I thought it'd be fun to actually have some cocktail napkins make and pass them out. So we're looking to trade, as a general statement, pullbacks. So you get an entry, we place a stop just in case we are wrong. We have an initial profit target, and that's going to be half, where we sell half of our shares. And then if that trend continues, we're going to trail that stop loosely throughout. Now, I'm going to break all this down in just 1 second. So let's say we have a nice little trend, and we have a nice little pullback in that trend, and we get an entry. Now, this reversion to the mean move in the direction of the trend, in other words, a bounce from oversold in that pullback, this is a fairly certain move. The longer term trend resumption is going to be a lot less certain. Now, people say, well, Dave, could you give me a percentage on how certain the setup will work? What's the percentage work, etc. Well, I really can't give you an exact percent on that, but I could tell you that it's much more likely to make that shorter term move than it is to make this longer term move. Now, years ago, I did a lot of trend following type of testing, and I discovered that 72% of the time, longer term trend following just flat out doesn't work. And you're only going to be right about 28% of the time. Now, it's very hard, round numbers, to be wrong over 3/4 of the time. And the way I solve for that is, well, let's take a swing trade and then let's take half of that off, and then let's stick around just to see what's going to happen. And through this, I discovered that you're able to have your cake and eat it too. And I'll show you how to do that in a few minutes. So again, we're looking to take a partial profit, and you're not going to get rich taking these partial profits. You'll make 1% on your account, and I'll show you the math again. But it does help to keep the lights on. Now, this longer term trend, should it begin to develop, is where the money is. Now, we take those partial profits just in case we're right small, and then we stick around with the remainder position just in case we're right big. Now, people have asked me before, is your money management psychological or statistical? And my answer to that question is yes. Now, not to go all freshman psychology on you, but if you get to Maslow's hierarchy of needs, obviously at the bottom we have Wi-Fi, but once you get past that, if you're taking short-term profits, you're getting that short-term fulfillment that we crave. And this is especially true in this microwave society that we live in. We're expecting immediate results. But the real money and the real longer-term capital growth and self-actualization comes with the longer-term trend following. But again, if you were just longer-term trend following to begin with, you're going to be wrong over 3/4 of the time, and that's going to be a very, very negative thing. So my goal is to climb that Maslow's ladder by taking the short-term profits, but sticking around, again, in case a longer-term trend ensues. So let's take a look at the math of what I'm doing here. We're going to risk 2% of your account if you're stopped out. That doesn't mean risk 2% on the trade. If it goes 2% against you, get out. No, if the entire position goes 2% against you, against your account, then you would get out. And I'll explain that in 1 second. So your stop's going to be based on the volatility of the stock and where you would be wrong. Your initial profit target is going to be the entry plus the stop distance. And then we're going to gradually lose that stop on the remainder in an attempt to ride out a longer term trend. So let's break that down. I'm going to risk 2% of your account if you're stopped out. So if you have a 100K account, 100K times 2% equals $2,000. Now let's say you were looking to get in a stock and you had a 1-point stop. You would buy or sell short 2,000 shares. 2,000 divided by 1 obviously equals 2,000. Now let's assume that the stock is a little bit more volatile, so you're using a 2-point stop. Well, 2,000 divided by 2 equals 1,000. Now bear with me. We're going to get to the secret sauce here in just 1 second. So this is the live portfolio right now, and I have positions in these stocks. So in this particular case, this short position on TSCO had a 10-point risk. So remember earlier we saw a 1 point, a 2 point, well, 10-point risk. We're only going to short 200 shares. And you can see up here we have the trading loaf, which we took profits on already, and then we have the trending loaf. Now up here, this is a little volatile gold stock, much more volatile than Tractor Supply, but we have a much smaller point risk. So if you take 2,000 divided by 0.7 point risk, and that's going to give us 2858 shares, rounded up, and 1429 would be in a trading loaf, so to speak, and 1429 would be in a trending loaf. Now, I would actually round that up probably to 1500, and I forget what my position is per 100K on this, but probably about $3,000 if I had, 3,000 shares if I had to guess. Now, down here, this technically triggered today, but not enough to be able to discuss it just yet. But notice that we were looking to buy 4,000 shares per 100K because our stop was only 0.5 away. Now, it's a very volatile stock, but it's very low price too. Now, last week we talked a lot, or a couple of weeks ago, I should say, we talked a lot about how to set that initial stop. And just a real quick review. Basically, you want to make sure you're outside the normal volatility of the market. So if a market is bouncing around 3 and 4 points a day, you can't use a 1-point stop. You're almost guaranteed to stop out of the position. I can all but guarantee that. So let's say we were trading, this is just one example, and we had many a few weeks back, but go in and watch that video if you get a chance. But let's say a stock breaks out and then begins to pull back a little bit. We're not breakout players, we're pullback players, but when it begins to pull back, we look to enter if and only if that trend begins to resume. Let's say we trigger in, and then unfortunately, let's say the stock drops back into the base. So our stop should be somewhere near or in that base because we know we are wrong in our trade. Now, I was thinking about this before we went live. If you could figure out your initial stop, where you're going to place that initial protective stop, you figured out quite a bit. From that, you know where your initial profit target is going to be, and then you have a basis to begin loosening that stop as that trade moves more and more in your favor. And I guess I should say if it moves more in your favor. And that's why I spent so much time a few weeks back talking about how to set that initial stop. Now, one of the greatest examples for setting a stop is if we have what's called a textbook TKO, and that's where you have this nice wide range bar. And I think last week we covered TKO, so go in and watch that video to get up to speed. But if you take the entry minus the stop, that's going to give us obviously the risk. We add that back to the entry, and then that's going to give us the initial profit target. Now, we're going to gradually loosen the stop on the remainder to ride out a longer term trend. So again, we're taking that swing trade profit and we're using a fairly tight stop to begin with. So we kind of play the position close to the vest to begin with. But as things begin to open up, we begin to open up our stops. And by the way, I get a lot of questions. Hey, can I use this in day trading? Absolutely. I think that if you're going to day trade, you need to be an intraday trader and not a day trader per se, where you're in and out, where you want to go in and try to capture this. So even though this is a daily chart, imagine this is a intraday chart. Well, go ahead and take those small profits and then gradually loosen that stop up the rest of the day and hopefully squeeze out a big profit on the remainder. So notice that in this particular example, our stop becomes wider and wider, often by doing nothing. And I'm going to walk you through that in just 1 second. So this allows you to have your cake and eat it too. Now, let's take a quick break for a commercial. When we get back, we're going to talk about the secret sauce. We left off, I was hinting at the secret sauce. And this is something that I'm really excited about. Years ago, I was on a project with a bunch of brainiacs, and it was one of those things where I felt like I wasn't worthy. And our job was to submit trades. And there's quite a few great anecdotes that came out of this, but one of them was I was submitting trades, And I was being very patient in submitting them. I wasn't submitting them every day, so it would take sometimes weeks for me to come up with a trade. But luckily, by being really patient, the trades were really working out nicely. And I was putting my money management into place where we were taking partial profits and then trailing that stop higher. And one of the guys on the team was I don't know if he's a PhD, but he was running a hedge fund that uses arbitrage. And I thought everybody knew this, like Pinocchio being a bad motivational speaker from the Geico commercials. And he said, it's really cool what Dave's doing, the way he's taking those partial profits just in case he's right small, but he's gradually loosening up that stop just in case he's right big. So that was pretty exciting for me. And I really think that this is the secret sauce to trading. Now, those of you who don't know me, my nickname is Big Dave. Now, I like to see it as playing with the market's money, or better yet, free rolling. I was the guest of honor at Charlie Kirk's retreat last December, and when I started talking about money management, he began to say he really liked this free rolling aspect of things. So I think that name might stick. So getting back to this example we kind of beat to death on, you can see the trading loaf. We're only looking for a 1% profit overall, but notice up there, that's 18%. It turns out to be 18% because that's about our stop, our initial stop was. But then we're keeping half of that position for the trending loaf. So again, we're looking to enter on a swing trade. In this case, was a TKO. And then we had initial profit target, which was the entry minus the stop plus the entry, as I discussed earlier. And then we have a trailing stop on the remainder to ride out that longer term trend. Now, here's the thing. You widen that stop out because it's going to require a wider stop to stick with that position longer term. And also that position, if you do it right, you're going to capture an acceleration in that trend, which is going to increase the volatility of the stock. And then as the price gets bigger, you're going to need a wider and wider stop to ride out the corrections. Now, you never know whether the correction is going to turn into a bottom five reversal or not. Bill Dunn said it the best, and this was from Covell's book on trend following. He said, riding the trend is like riding a bouncing Bronco, and it really is. So to trail that stop, when we first get started, we're going to trail more on a 1-for-1 basis. So if the market goes up 1 point, we're going to raise our stop 1 point. Now, in more recent years, I've become a little bit more lenient in the trailing stop, meaning that I'm not as much of a stickler. If it goes up 1 point, I might not raise it a full 1 point on the first loaf. And that's helped me stick with a few trades over the years. Now, once we are able to get that initial profit target out, we're going to go from stair-stepping that stop higher to allowing it to gradually open up. And you can see in this case, as the trend moves more and more in our favor, that stop gets wider and wider. So getting back to the previous example, you could see that if you were to look at the stop at various times during the trade, initially the stop was fairly tight, but notice over time, as the stock moved more and more in our favor, it became wider and wider. Now, a lot of times you can let that stop widen out by simply doing nothing. So how do you loosen? Well, on a small, modest move, you don't do anything. If the stock moves a few cents in your favor or whatever the market you're trading, then you don't have to do anything. Now, if it makes a really nice move, you might trail, but less than a 1-for-1 basis. And that's how you allow your stops to widen naturally. So let's say the stock moves higher, you might not do anything in certain cases. And by leaving that stop alone, it begins to widen out. One thing I learned early in my trading in the mid-90s, probably 1995 or 96, I had a broker that whenever I get kind of bummed out, I'd cry on his shoulder, and he would say, Dave, make it a game and have some fun with it. So I've never forgotten that, and that's really helped me out through the years. And one of the games is I call keep the change. Let's say a stock goes up a few cents. Well, don't do anything. Just leave the stop where it is. I call that keep the change. And sometimes that'll happen over a period of several days. It'll go up 34 cents or 15 cents or 10 cents, whatever the case may be. And after a while, that stop can gradually widen. And then you reach a point where you'll start to tighten up a little bit. So again, don't do anything on small moves. I call that keep the change. Now, the other thing I call gaining ground. So let's say a stock goes up 3 points. Well, you might only raise your stop 2 points. Okay. Now I see a mistake in the slide. It should be say raise stop 2 points. So the way I look at it is you need to view it as making 2 points on the trade. And one thing I'd be careful about is mentally monetizing your gain. So if you're like, oh, wow, I'm up 5 points on this trade, I could buy this or I could do that. That could get you into a lot of trouble. But if you must mentally monetize to where your trailing stop is. And again, I'm sneaking in a little bit of trading psychology. So again, in this case, gaining ground, stock goes up 3 points, you might raise your stop 2 points. Now, the thing is, how much is enough? Well, when you begin to think, ouch, that's going to hurt, is when you realize how wide your stop has become. And keep in mind that on a lot of these charts that I'll show you, we've caught some fantastic trends, but in the end, we've given up a lot. And then sometimes I'll go back in and 2 and 3 years later, I'll look at that same chart. I'm like, oh my God, we were long this stock a couple of years ago. We got knocked out and this stock has quadrupled in then. So even though you give up a lot in the end, sometimes an even wider stop would have kept you with that trend. George Carlin once said, when you buy a pet, it's going to end badly. Easy for me to say. My corollary to that is when you make a trade, it's going to end badly. And it's just one of those things that you have to get over. So if you're trend trading, you're going to have to give up some of that trend in the end. One of 3 things are going to happen with my methodology. You're either going to flat out lose, you're going to make a little and then break even, or you're going to make a little and then ride out a longer term trend. But in the end, you're still going to give up quite a lot. Some people will email me to complain, hey, Dave, we gave up 15 points on this stock. That's a lot of money to give up. But they still made 150% of the trade. And I'll just say, well, you know what? Send me that money and then go get yourself a massage and get yourself centered and just forget about that trade. In 20-something years of doing this publicly, not one person has sent me the money yet. But I'm hoping. So it is painful in the end, but if you quit, you're never going to get to that occasional home run. Now, doing nothing is a lot harder than it sounds. Ken Lambert said that. Doing nothing is a lot harder than it looks. And then there's been plenty of other people who have much more eloquent things to say about being patient and letting the positions unfold. But my biggest thing that I've come up with is that there's always a reason to exit a trade and rarely a reason to stay. In fact, the market is going to probably go against you more often than not. But if you're ever going to capture a longer term move and make money longer term, you're going to have to stick with the trades. Now, this portfolio is a little dated. If you go back and look at the portfolio I showed earlier, you can see the current portfolio. And I will bring that up in future shows and continue to update it so we can see how it shakes out. But in this particular case, you could see that we have some trades where we were able to get that swing trade out. Notice it's right about 1% per 100K. And then we held on to a piece, half, for that trend trade. So if it's white in this spreadsheet, it means that we have taken partial profits as a trader. And if it's yellow, or highlighted, I should say, we're still in the trade. Now, I will give you guys this spreadsheet, and I'll make that part of the slides. Now, let's talk about the mystery charts. So last week, I showed a couple of mystery charts, and you guys were pretty smart. You figured out what they were. So congratulations on that. Now, the first one was CMRE. and we had a TKO. And it was kind of textbook in nature. We're going to buy above the high of the TKO bar and put a stop in below the low. It triggered. It was kind of off to the races at first, but so far it's come back in a little bit. Now, the other one was PLMR, and I'll give you all the parameters on these next week. And if you go and look at the spreadsheet that I showed previously, you can get them from these slides. So we had a buy here on this one, and we had a TKO. And this was once again another one of those textbook sort of TKOs where we're getting in right above the high or close to the high, and our stop goes below the low. And so far, it hasn't done a whole lot just yet. So I thought it'd be kind of fun to show some open trades, show them as a mystery chart before they happen, and then follow up with them. That way, no one can argue about things being in hindsight. Now, here's our next mystery chart for this week. And you guys are pretty smart, so I took the scaling out this week because you were able to figure it out last week. But notice that we have a nice trend higher. Now, the other thing you'll notice in this chart is the trend is not only going higher, but it has begun to accelerate higher. And you can see right here, the stock began to take off nicely, and then it's pulled back. And we had a trigger. And let's see if I have that marked in here. Nope, right around here. Oh, okay, I know what. The trigger did not, so far, it didn't trigger because it rallied up a little bit this morning. It came really close to triggering, but it didn't trigger. So let's see if we could draw in a couple things on this particular chart as to why I like it. And Rachel, if there's any questions, let me know. I'll be happy to address those.
Will do.
So in this particular case, we had a gradual trend higher, and notice that it began to accelerate higher. And then the stock begins to pull back. So again, we're looking for that reversion to the mean move back in the direction of the trend. That's just a fancy way of saying a pullback. Now, as we said earlier, there was this right here is fairly certain, and I wish I could give you an exact on that, but there really aren't any exacts when it comes to trading. But this move here, again, is fairly certain. So we're looking to take some profits somewhere up here, a little bit past those old highs on this particular one. And if that happens, we're going to, of course, as it moves in our favor, we're going to trail that stop higher. But then we're going to exit half of the shares up here. And I hope this one works out. I know you should never use the word hope in trading, but hopefully it'll work out. And if it does, I certainly will follow up on this in other ones from now on. So again, you want to look for that initial profit target. And we're going to, in this particular case, we're looking for half. Looking to take off half of the position. And that's going to be your swing trade. And then from there, you're looking to trail that stop higher, and that's going to be your position trade. Okay. Getting a lot of questions on where to find me. You can find me at davelandry.com/StockCharts. If you go there and put your information in, I'll get you all of the information mentioned in these presentations. And if you need to reach me directly, just give me a little time to answer emails. You can go to davelandry.com/contact. Now, right as we were going live, I got a question about portfolio allocation. What I do there is I let the database tell me what to do. Right now, I'm seeing a couple of shipper stocks that are setting up that look pretty interesting to me. A few weeks ago, and you can go in and look at the presentations, we had a couple of shorts that was showing up in the software stocks. So right now we're long some shipping stocks, one in particular, and we are short some software stocks. And that's just because that's what the database has shown. I want to thank everybody for coming again this week. If you have any unanswered questions, feel free to shoot me an email. So.